Yo, welcome back. All right, episode 28. We are here. So this episode is really gonna be based around paying off your mortgage early, or do you take that and you invest the difference? So there's a lot of conversation going around right now on social media. Is if I were to hand you a lump sum of money to pay off your mortgage, would you take it, pay off your mortgage, or would you actually put that in an investment vehicle like the stock market and let it grow over time? So I went ahead, I pulled up some data, I pulled up some facts, and then I'm also going to talk about what I would do in my current situation. So it's very interesting because, I mean, honestly, can you really go wrong both ways? Technically, no, but at some point, when your interest rate's a certain amount, which I'll go over here later in the video, then yeah, you're going to consider actually putting that money into the market instead of actually paying off your mortgage, even though the mortgage is probably your most expensive bill, right? So I really got inspiration off this video because I was watching Graham on YouTube. So if you ever follow Graham throughout his journey, he's one of the biggest online real estate investors. So he recently released a video basically talking about how he felt like, looking back at the numbers, his journey wasn't really worth it. And he could have earned more by actually investing into index funds. So this is basically what he was saying. He's basically, after all the expenses like the taxes, the insurance, the basically all the random expenses that comes and the fees that come, and taxes always continues to grow as well on these property taxes. He said the total cash flow came out to about 4 to 5%. So when you're coming out to like 4 or 5%, you have the S&P on average getting a 10% return. So, I mean, you can get literally high yield savings accounts at banks for 4 to 5% and not have to deal with the home repairs, not have to deal with the property manager or deal with the tenant. If you don't have a property manager, you don't have to deal with the taxes, a down payment, like the massive amount of money that you need as a down payment, right? So it was just very interesting. And also all your money is not tied up into the equity of your home, because if you own a home, you can't just tap into that equity. You either need to do a refinance or you have to take out a HELOC. So of course he's selling out his properties. He got them during COVID. So I mean, the man's about to cash out. Like, we're not going to sit here and act like he's not about to cash out. But what he's basically saying is his opportunity cost would have been much better by putting the money in the actual stock market. Because again, he doesn't have to worry about the upkeep on the home, doesn't have to worry about a random storm coming in, destroying the home. He doesn't have to worry about the insurance and all that. All he has to worry about is the growth, and then, the taxes that you will have to pay on the growth. Right. So, it's very interesting. So, I mean, that's why I wanted to really make this video, because I was like looking now, thinking, sitting back and thinking back. I mean, I'm not a real estate investor, but I'm thinking like someone who does, pay attention to the stock market, someone who does invest. I'm like, man, like, is that maybe the route to go? So I guess again, we're going to talk about it here in this video. Um, the last point I'll make before we actually jump in the video is I honestly don't think you could go wrong by just having both at some point in time whenever it makes sense, right? So when we talk about investing, you talk about your portfolio as a whole, you want to diversify. And part of diversifying is real estate, because real estate is also a well-known, proven way to build wealth, right? So basically my look on it is, I'll talk about more in the video, but basically, it is good to kind of have both, because once you have both, now you're having two vehicles, two really well-known assets that's going to make you money, and that's going to build wealth. Disclaimer: the information provided on this podcast is for informational and entertainment purposes only. It should not be considered as financial advice. We are not licensed financial professionals, and any opinions shared are based on personal experiences and research. As always, do your own due diligence and consult with a certified financial advisor or professional before making any investment decisions. All right, so now we're going to talk about why your rate matters. So Freddie Mac. Freddie Mac is a government-sponsored business that tracks and buys homes. And they're reporting that the average interest rate on a home right now is 6.5%, right? So when you're looking at that, one thing you want to look at is the average rate of return for the S&P. So the average rate of return for the S&P is about 10%. If you factor in inflation, it comes out to about 7%. Remember 6.5 and remember the 7 to 10% because that's going to be very important as we continue the video. So, but what if I bought my house during COVID? What if I got my house at a 4% rate, a 3% rate, under a 3% rate, right? So what if I got it at such a low rate, knowing that the S&P has a 10% annual return over its time? So this matters because rates basically doubled since COVID. So again, we're going to remember the 10%, we're going to remember the 6.5, and then it's going to make sense as we go on through the video. So it does matter because now rates doubled since COVID. And I don't really see rates going to those levels, at least in my lifetime. So I'm saying this because if I have a 6.5% interest rate on my home, maybe I would actually look to pay off my home because the rates are so high. Like it's hovering at 6.5%. Like the rates are so high right now. Like, yeah, maybe I would take the safe bet and pay it off. But if I have a rate 3%, 4%, 3%, under 3%, I know I can beat that in the market. And this is where opportunity cost comes into play. Like I know I can go beat that in the market. So why not just take the 100K and put it into the market? Because if I have a true COVID rate, I really don't. One, my mortgage payment is very low because the rate is so low. And then at the time when you bought the house compared to the prices of houses now, it's not even a comparison. Like right now, if I would have bought my house today compared to what I did during COVID, I'd probably be paying 2 times a month in just mortgage on what I do now. So when I'm thinking of that, I'm thinking, okay, if my rate is so low, my minimum payment is so low, that's comfortable. I can manage that. So I can take that 100K and I can go invest that. But if my rate's 6.5%, 5%, then yeah, it would make sense to, pay your mortgage off because now one, you're getting off 6.5% from 100K. And that's fantastic because again, it's basically a guaranteed return because you're paying that house off and then that's coming back into technically your equity, right? So it's technically a guaranteed return. So I'll explain it more here in just a moment, with the math behind the madness and kind of how I'm picturing it and how I'm thinking of it. All right. So here we are, the math behind the madness. I told you, remember the rates of 6.5 to 4%, 10%. This is where we're going to dive a little deeper. All right. So say you have a 6.5% rate on a 30-year mortgage and you bought it for 300K. In 10 years, you would pay $181,000 in interest. Take the same loan, you do it for a 4% rate. That's $108,000 per, basically throughout that 10-year period. Now, if you take it at 2.75%, that drops all the way down to $72,000. That is why the rate is so important, especially when you're dealing with a large number like a mortgage. Now, let's just say you take that 100K, you put it into the S&P. We're going to do 8%. I know I've been saying 7%, 10% throughout the video. We're just going to do 8%. That's a good rule of thumb. It's very, possible to get 8% over a 10-year period in the market for sure. So your investments would be $215,000. And just keep that in mind that this is just an 8% rate. If we went up to 10%, your investments would then be worth $259,000. So if you're wondering where I got like the mortgage information and the numbers, I actually use Claude and ChatGPT to actually help me formulate all this. So this is why the interest rate matters and what you're going to do. Because as you can see, if I took that 100K, put it at 8% in the market, I'm getting in 10 years, I'll have $215,000. And I'll explain like what I would do in this situation, because when you're looking at the numbers, even if at 6.5% rate, right, you're still earning more than what you would pay in your interest. And that's where the opportunity cost comes into play. So I'm going to explain what I would do. All right. So before we close out, I just want to say, I was actually lucky enough to buy my house during COVID, and here's why. Because I knew I was going to get a really low rate. I knew I wasn't going to pay 1,700 for a townhouse, and obviously you don't know how the market's going to go, but it's pretty nice now, to see the equity we built in our house just for how much the value of homes appreciated over the time from COVID to now. So realistically, what I would do, and this is where personal finance comes into play, because again, my situation may be different than yours. It may be different than the next person. But what I would do, I would actually take that money and I would deploy it into the stock market. And here's my thought process. One, I'm going to beat 2.5. I'm going to beat a 2.75% rate in the stock market, right? I'm going to beat that. If I don't beat it, and let's just say the market falls flat or it goes negative, usually when you see a year like that, usually you see the stock market bounce back and have growth at a very high rate, right? So usually when you see a crash like that, or when the stock market doesn't really earn, or it actually goes into the negative for the year, then you tend to see years of straight growth at a very high rate. So in my mind, I'm like, okay, I'm going to take it and I'm going to bet on myself, because what I could be doing as I'm investing this one large sum, I understand 10 years I'm buying at a very cheap price. So we all know that stocks appreciate, or usually indexes, I should say stocks. Indexes will appreciate. So if I put it into an index like the S&P, earn 10%. I know earning 10% is going to give me a value of $259,000, right? So one thing I'm also accounting for during this 10-year period is I'm still paying on my mortgage, right? Like I have to pay my mortgage. So I'm still paying on my mortgage over a 10-year span. So when the 10-year mark hits, not only will I have $259,000 chilling, but I can take a part of that, pay off my mortgage. My mortgage is gone, and now I'm continuing fueling my investments, and it's already still investing on its own because I didn't have to take all of it to pay off my mortgage. So just in a 10-year period, I was able to go ahead and knock out both. And that's kind of my mindset and honestly, during that other 10-year period, I can have the 100K. I can dollar cost average to what I already budgeted now on top of paying my mortgage. So it honestly, it just fuels it even more. So potentially I can have more, because this really is if you just drop the 100K in and just let it ride. But if I can drop the 100K into the market, dollar cost average while paying off my mortgage, wait 10 years, I can pay off the rest of my mortgage and continue building my portfolio at a much higher rate. And I would have way more money and way more value than I would just paying off my mortgage. So that's where the personal finance comes into place. And this is where, again, you have to do your research, because you have to identify what works best for you and your family. And for me, I understand, hopefully in 10 years, knock on wood, anything can happen, but hopefully I'm healthy enough to where I can continue paying my mortgage. I can continue dollar cost averaging in. And on top of that, I already have 100K in one lump sum from a 10-year period. So the opportunity and the growth and the money that you will have by just putting into the stock market, because my rate is so low, it's night and day. Like, it's night and day. I don't think anyone would sit here and say, well, I had a potential of losing a couple $100,000, but my mortgage is paid off. Like, no, because realistically, you just be able to do both. It would just take you 10 years. But you don't get rich overnight. You don't get wealthy overnight. It takes time. And what they usually say is, once you hold, once you wait, once you play that waiting game, you typically get better returns and better results. And this is just a way that you would get better results. Now, if my rate was at 6.5%, then yeah, maybe I would look to put it onto my mortgage, cash refi, do the whole thing, like whatever the case may be, right? Just depending on what rates would be, right? If I'm at 6.5, I put the 100K onto my mortgage. I wait for the rates to drop a bit. Like, this is just kind of how I would think of it. I wait for the drop a bit. I already have 100K just knocked off on top of paying my mortgage until, who knows when the rates drop, right? But they go to 5%, boom, cash refi, I'm pulling that out. Now I'm getting in at 5%. So it goes down to what works best for you and your opportunity cost. And for me, my opportunity would be to just take the 100K, let it ride, dollar cost average in like I usually do. So again, this is just an exercise I wanted to put together. AI actually helped me put this exercise together. It was actually I learned a lot, and it kind of opened my eyes quite a bit when I watched Graham's video, and then did some research on my own and start putting some numbers together on my own. So again, don't forget, you know, like, follow, share, and thank y'all for your time.